TSMC, so Taiwan Semi for short. Taiwan Semi is the longer, but TSMC, better known as Taiwan Semi. Now, this company, they actually manufacture the semis for semi companies. So they are the foundries that actually make the semis. Okay, let's get started with TSMC. Net income margins are very solid, have been improving drastically year on year. It's very impressive. It's above its newest competitor, Intel, 33%. Very, very satisfying. Growth in costs are very minimal. It explains the out of this world margins basically. You're growing margins at an explosive rate, but not really spending that much. Now we're gonna get to why it doesn't need to spend that much. Now TSMC, Taiwan Semi, basically it's an accidental monopoly. You know, considering that 90 or so percent of the most advanced chips, uh, TSMC is probably responsible for that. It owns around about 57% of the semiconductor market. So I mean, you just imagine that 57% of all chips are made by Taiwan Semi. So it's an active monopoly. It basically operates in a league of its own. So what I want to show you is that it does not need to spend all that much to prove its market or fight off competitors. Virtually, there are competitors, but not close. They're really, really, really not close. So whatever rate it spends at, that is sufficient, that is appropriate, that is more than enough, because that is what the market demands of. Now, furthermore, the strong margins are evidenced by low spending on R&D. If you look at R&D as a percentage of revenue, one might think, whoa, that's a red flag. No, not really, considering, yes, the industry average is about 20%, and Taiwan is the industry average is what? About 20%. I think Intel's on about spending 20%. But it's not worrying, because you have to understand Taiwan Semi, to a very large degree, has been investing way before. So right now it's realizing the expenditure in R&D that it did way back, probably half a dozen years ago. So it's basically now realizing that expenditure. So now it doesn't need to spend that much because it's in a league of its own. Nobody's close enough, and its customers are happy. Because customers are happy because I mean, look at the rate sales is increasing. Look at the rate income. If you look at the margin, it's still dominant in its market position. So it does not need to spend above what it already considers as fair because we're in a dominant position. It does not need to spend what it already considers as fair or what it's spending right now because it's already growing margins, growing its market share, and it's improving its level of customer quality. A lot of customers, so a lot of semi manufacturers are more than happy with Taiwan Semi. So now this spending, as conservative as it is, it reflects the market rate. All right, it is the market rate basically. So Taiwan needs to grow cost, improve quality, maintain dominant position. Yes, it does. However, this is all it needs to spend. So all costs are justified considering that Taiwan Semi is growing revenue at a compound rate of 14%, whereas Intel is only growing at 8%. The spending, like I said, conservative as it is reflective of the market. This is the rate that Taiwan Semi needs to spend or to grow costs at to improve and maintain its dominant market position. And it works. It is improving its market position, it's growing sales, it's growing margins, and it is um, it's improving its market condition as nobody's near. It does have competitors, but they're basically trading. So all costs are justified. We talked about that. Now the net income growth is significantly supported by the strong margins, excellent cost control, and hypersonic growth. Yeah, it is excellent margins, tight cost control, doesn't need to spend what it does not need to spend on. It does not need to spend more than this, considering this is there and hypersonic growth in revenue. So the ROE is fantastic. There aren't any good words in the dictionary to describe how fantastic this is. Um, Considering that the S&P 500 over the what is it 2018 to 2020 year returned about 16%. Taiwan Semi over the same period returned 27%. So this is more than good. This is out of this world. So Taiwan Semi obtained returns on capital invested on operations twice, two times more than the S&P 500. So that's very good. So profitability of Taiwan Semi, it's mainly driven by the dominant market position. As uh, every semi company that needs wholesale production of advanced semi basically makes use of Taiwan Semi. The who's of the semi industry makes use of Taiwan Semi. Now the financial position, you will see that there has been a decrease, uh, but it has still performed better than Intel's nearest competitor. Intel averages about 1.68 in terms of the current ratio. Taiwan Semi is at 1.92. So outperformed the nearest competitor. The same with the asset test. Intel had a asset test ratio of about 1.29. Taiwan Semi has an average um, asset test ratio of about 1.71. So it significantly outperformed its nearest competitor. The asset test, yeah, it has depreciated slightly in 2019, but has rebounded significantly in 2020. So even though there has been a decline, understandable because it's been using cash to fund operations, fund growth, as well as protect its market share. However, this decline is not a heightened increase of liquidity risk. Taiwan is still in a strong liquid position. It still has more than enough current assets to settle current liabilities, more than enough liquid current assets to settle current liabilities, in a very strong liquid position, and it's outperforming its nearest competitor. That's very good. The liquidity position of Taiwan Semi is very strong. The inventory days, the inventory days just support the strong market position of Taiwan Semi. I mean, it paints a picture of a company that cannot make semis fast enough. Intel's inventory days is at 98. It's just over 98 days. Taiwan Semi average is at 67. So the performance is far greater than its nearest competitor. It just paints a picture. I mean, just looking at it, it just paints a picture of a company that really does not carry that much stock, and that will be supported by the current to asset test. Because when you look at the current ratio at 1.73, excluding inventory asset test, it's at 1.53. So it just shows you that as a dollar amount, inventory is not a large part of the balance sheet of Taiwan because it doesn't hold that much inventory. So I mean, but good performance, a fantastic performance. So very low inventory risk, because on average Taiwan Semi only holds stock for like 2 months. So that's doesn't hold stock for that long. So low carrying cost as well as low risk of the inventory being obsolete. So very good asset management there from Taiwan Semi. The debt to equity ratio has increased, to 26, 40 to 50%, but it's still far below that of Intel. Intel on average has a debt to equity of 79%. So even though it's increased, Taiwan Semi still has a debt to equity far below the industry average, far below the industry average. So it still has enough room to add debt without significantly burdening the balance sheet with risk. Uh, and of course, there's been a productive use of debt. When you look at the debt risk to return ROE relationship, as debt has increased, ROE has increased. So this just shows you that Taiwan is very efficient, very efficient in utilizing capital and achieving returns on um, invested what is it, in operation. So in any investment that Taiwan make, any capital used to invest in investments does realize an above market return, and it's been very efficient with the use of its debt. Very good, very good, very productive with the use of its debt. All right, so cash margins are just ridiculous. They're ridiculous. They are really ridiculous. They're just ridiculous. I mean, just stand for a second and admire what you see now. This is just beyond good. It's beyond great. This is out of this world good. Um, Above, obviously, Intel. Intel was sitting at about Intel. Its average is about 44%. Taiwan is at 58%. So good business model, a business model that indicates to one that Taiwan Semi can convert revenue into cash. 61% of all revenue generated can be converted to cash. That is fantastic. That is out of this world. So increasing hypersonic margins that are above the market. This is fantastic. I mean, this gets a big tick mark for me. Now, the margin, yeah, it's beyond perfect. The sufficiency of cash flow. Intel's sufficiency of cash flow is on average 0.86. Taiwan Semi's average is on Taiwan Semi's average is 0.92. So above the industry average, has declined significantly. It has improved significantly actually. Declined slightly in 2019, but improved significantly in 2020. So there has been a significant improvement, bearing in mind that entities in the semiconductor industry tend to keep a sufficient cash flow below one. The fact that Taiwan Semi has it above one, on average, is outperforming the industry, is again nothing short of perfect. It's pleasing. It's beyond pleasing. It's a tick mark, 100% or 100%. It's a tick mark in every single metric. This company is beyond perfect. Pays a decent amount in dividends. It pays dividends at 37%, a good return in my view. Its PE is at 34. Intel's P is about just over 10, around about 11. Um, yeah, I mean, in my view, that's a cheap PE. Considering what you're getting a company that overperforms its nearest competitor in each and every single metric. A company that is virtually a dominant, unchallenged, accidental monopoly, by the way, that that accounts for what 56, 57% of all um, chips made are basically made by Taiwan Gaming. It has a dominant market position, outperforms its competitors, strong margins, strong financial performance, healthy liquidity and balance sheet, significant cash generating ability, and gives a return. And sitting at 34, I mean, that is just pretty low. That is very low. Now, Taiwan Semi, in my view, is operating at a massive discount. Um, it, it should be trading at least 40% higher than what it is, and you can see that with the P of just 34. But that's because of China. The fact that there's a threat that China might take Taiwan, which is the country that Taiwan Semi operates in. The fact that there's a risk that China might take the country by force, you know, that uncertainty, that political risk, basically has discounted Taiwan share price for quite some time. But I mean, it should be trading higher than this. It's a very good company.